Okay, let's get started. Good morning, everybody. Welcome to a special Private Equity Career News webinar, how top originators are gearing up for 2022. I'm David Toll. I'm the publisher of Private Equity Career News, and I'm going to be your moderator for the program today. I'd like to start out thanking our sponsor, SBS by Bain & Company. SBS is an award-winning provider of actionable data and analytics for private equity firms seeking to optimize their deal sourcing programs. A few housekeeping announcements before we get into it. A friendly reminder to any reporters on the program today that we are off the record. Please reach out to the speakers individually for permission if you would like to use anything that they say today in an article. Second, you can download a copy of the slides for today's program from your control panel. That's about sort of toward the bottom of your control panel under handouts. You can also download a copy of the results of a survey of BD professionals from earlier this year. Includes a lot of valuable information on industry-wide practices. Later today, I will send you a recording of the program, so no need to take extensive notes. And finally, many of you asked questions of our panelists when you registered for this program, and we will plan to address those questions during the discussion portion of the webinar. Please, though, also at any time during the program, ask questions through the question feature of your control panel. I'll be keeping an eye on those and making sure that we get to them. So I'm grateful to have 4 expert speakers today to guide you through the topic, starting with Nadim Malik, founder and CEO of New York City-based SBS by Bain & Company. Nadim is going to present statistics revealing the arguably overheated state of the M&A market, and also address the role that technology plays in helping deal originators see a higher percentage of relevant transactions. This next speaker probably needs no introduction to this crowd. Many of you know Jeremy Holland, the Los Angeles-based managing partner and head of the origination team at the Riverside company. The Riverside company has been investing in lower middle market companies around the globe for more than 30 years now. We also have Chris Petrossian, Managing Director at Chicago investment bank Lincoln International. Chris co-heads the firm's consumer group and also heads the Los Angeles office. And we have Scott Reed, co-head of US private equity in the Boston office of money manager Aberdeen Standard Investments. Scott helps lead a team of investors backing lower middle market buyout funds and co-investments on behalf of big institutional investors. So before we dive into the program, let's find out just a little bit more about our speakers, starting with Jeremy. Jeremy, give us a little more color on the Riverside company and the role that you play there.
Sure. Well, thanks for having us. The Riverside company, as you mentioned, has been around for more than 30 years. We manage perhaps about $13 billion globally. That's spread across 9 different strategies, funds, teams around the globe. So we have a fund for Europe, one for Australia, and then here in North America, control, non-control, debt, equity. We have some specialty technology vehicles ranging from B2B SaaS companies as small as 3 million in revenue, all the way up to pre-IPO unicorns. So we cover a pretty broad range of the entrepreneurial end of the market. And so collectively, we're arguably the biggest private equity firm in the world that has maintained a focus on the smaller end of the market. As a result, we're transacting, buying or selling a company probably about every 5 days at this point, which helps to give us perspective on a lot of different industries and geographies and trends.
An absolute deal machine. Thank you, Jeremy. Chris, tell us more about Lincoln International and your role there.
Sure. Thank you, David, and thank you to all the participants today. So Lincoln was founded 25 years ago. We have over 700 employees across 22 offices in 16 countries. We're focused on middle market advisory. So that's M&A, capital raising, valuations, opinions, and JVs. We consistently close over 230 transactions a year. We focus on deals of $100 to $1 billion, and we're consistently ranked in the top 3 for sell sides under $500 million.
Thanks, Chris. Scott, tell us about Aberdeen Standard and what you do there.
Yeah, so Aberdeen is a large global investment management firm. We've got presence in a number of different asset classes and a number of different geographies. And as Dave mentioned, I lead a team of private markets investors out of the Boston office, and we deploy capital in the venture arena, growth equity, and in buyouts. I personally spend a lot of my time in lower middle market private equity, where we make fund commitments, co-investments, and do a lot of work backing independent sponsors in direct deals.
And Scott, you're really bringing a different perspective from the direct deal approach with your co-investments. Can you just give us a quick sketch of how sourcing co-investments is different from direct investments?
It is different. So I spend a lot of my time engaging with the GPs that are in our portfolio, and that number's more than 100 over the past 20 years that we've been running this program, making sure that we are top of mind for them when they need incremental capital to get a deal over the finish line. But also spend quite a lot of time engaged in networking with the independent sponsor community. We're tracking close to 600 independent sponsors in the US right now alone, everything from one-man bands to truly institutionalized independent sponsors. And in that case, we are not only, our deal sourcing activity not only takes the form of building relationships with the independent sponsors, but also working with them to source direct opportunities in companies that we can collaborate on and pursue together. So it's different than what Jeremy would likely be doing in his day-to-day job. Different angle to talk about today for sure.
It's amazing how the population of independent sponsors has just exploded over the last few years. It's amazing.
It has.
Nadim, let's go to you to get your introduction and also to present some data to shed light on the current state of the deal market.
Thank you, everyone, for joining us today. I'm Nadim. I'm a CEO of SPS, which effective December 2020 is a wholly owned subsidiary of the consulting firm Bain and Company. Here at SPS, we're continuing to do what we do best. And boy, what a year it's been in terms of volume, and we're going to get into that here in a little bit. But what we do is we work with clients to position themselves for deal sourcing opportunities in the current market, or any market for that matter, using data, analytics, technology, and automation. In this kind of market, where from what I'm hearing often is all you can really be is reactive, since there's so much flow and everyone's drinking from a fire hose, as they say. It can be hard to be strategic, but when it comes to deal sourcing, the things we do now will bear fruit a year from now, give or take. So, and I don't think next year will bring record deal volumes like this year, though I look forward to our panelists' thoughts on that. So, and before turning things over to our panelists, I wanted to spend a few minutes, like David said, just framing our conversation with a few slides. And the slides are broken out into 2 parts. The first part consists of 4 slides around the market. And then the second part is a handful of slides on our recent deal origination benchmark report, DOBR Dover. This is an analysis we create for private equity firms to allow them to understand their relative deal sourcing effectiveness against their peers. In other words, are they top quartile deal originators? It also provides key insights on how to better direct deal sourcing processes going forward. And I'm going to walk through some high-level stats, as well as a few pages of what a customized sample Dober might look like for a client so the audience can get a feel for what the most relevant metrics the PE industry utilizes when it comes to their deal sourcing. So let's go ahead and get started with this opening slide. And boy, oh boy, what a market it is. I've never quite experienced something like this in the last couple of decades, where there's so much deal volume from investment bankers, private equity firms. Opportunities are kind of being turned down. There's staffing limitations, and things are being pushed to next year. And we can certainly confirm that with our data. You know, the P activity is up a staggering 55% compared to last year, and corporate deals are also up 34%. But the comparison to last year, which was a deflated year given COVID in terms of deal volume, might not be fair. But even if you look at 2018 and 2019, which were very robust years for private equity and M&A closed activity, their P activity is up around 25% on a comparative basis. Moving on to the next slide, the trend in prior years of the buy and build and roll-ups continues to grow in 2021, with PE firms completing 2.3 add-ons for every platform so far this year. To that point, we're seeing a growing trend by PE firms and BD professionals, especially as they get more sophisticated in their platform sourcing efforts, to get more involved in add-on sourcing for their portfolio companies, given it can be such a vital part of their growth targets, rather than just leaving it up to management teams, which is what we used to hear more often. Moving on to the next slide, here's a look at the most active sectors for private equity activity through the first 3 quarters of 2021. The services sector is at the top spot, followed by IT, healthcare, and industrial. And pretty much all the verticals are up across the board compared to last year. Moving on to the next slide, in case you didn't hear, PE deal volume is through the roof, and our data certainly backs that up. Deal flow in Q3 2021, as per this chart, was the highest we've ever seen by far, towering past the record set in the prior quarter, just the prior quarter of 2021. And given this, I think it's fair to say that closed deal activity will remain robust from now through the end of the year and probably into Q1 next year, just based on what we can see right now, which is going to keep our research team really, really busy, to say the least, in terms of tracking all this activity. So now that we've gone through the market slides, I want to talk through our Dober analysis and report. Just a couple of comments on methodology. Every year we take a static pool of our clients that qualify from a data integrity standpoint to be included in this. And past year it was 157 firms. And we look at each firm's market coverage, which is the percentage of relevant deals they saw that met their criteria, had a sell-side intermediary involved, and went to a private equity firm buyer. And a host of other metrics and stats, and allow them to compare their own metrics against their peers and the market in large. And before I get into a sample report, each client gets a customized report. I just want to walk through some high-level summary stats on this slide. So starting on the left, where you have large funds, then moving from left to right to middle market, lower middle market, and then smaller funds. And then within the middle market and lower middle market category, breaking it further down into generalist, quasi-generalist, and sector-focused funds. Large funds on the left, as expected, since they have fewer deals, have the highest coverage. But even there, in the larger fund category, top quartile is 38%, which means that if you're among the best, you're still missing around 60% of the relevant deals in your market. And those median, top quartile, and max numbers move lower for middle market and lower middle market funds, even if you're sector focused. We often hear the perception in the market that if you're very focused on a particular vertical, that you kind of have that market covered. it doesn't really show in the metrics. I think there's an opportunity for sector-focused funds to continue to expand their coverage using some data and analytics and taking some of the approaches that we have with our clients. Let's move on to the next slide. This is a first page of some stats that are more performance-based, hence the concept of top quartile is relevant. So if you're a private equity firm, the report's gonna start looking like this. And your particular metrics would show up where it says client metrics. And we start with coverage by intermediary type. So the top row is gonna show you what your share of relevant deals was, irrespective of the type of intermediary. And there's two types, boutique and most active. We define a boutique intermediary as one that only closes 1 or 2 deals to a private equity firm buyer in a year. And then most active is everyone else, 3 or higher. And you can, as a firm, see what your coverage stats are and how they compare to your particular peer group. And the sample that we've taken here is a generalist middle market fund. Moving to the middle row, we look at how much your coverage has changed in the last 6 months and in the last 12 months and how that compares to your peer group and the market overall. And then finally, through an algorithm, we created an index that allows every deal to be categorized as a limited, moderate, or broad process. And we give perspective on how your coverage has been in those categories. And we also enable the filtration of intermediaries themselves into which ones run the most limited versus broad processes, which is always eye-opening for our clients. Moving to the next slide, these stats are more kind of deal sourcing general stats. So the concept of top quartile isn't really relevant. Starting at the top, how many platforms and add-ons a particular firm did, how that might compare to their peers. In the middle section, some general metrics that are very common with key takeaways and important takeaways among our clients. What percentage of your deals were actually actionable? In other words, what percentage ended up closing at all? And if you're not familiar with our product and some of our stats, that number is probably going to come as a surprise to you, the pipeline closing percentage. Then below that, what's your annual deal flow? How many unique intermediaries are you sourcing from in a given year? And what's the ratio of deal sourced per unique intermediary? Once again, allowing you to put that into perspective. And then finally, in the bottom section, there's some nuanced metrics, which I'm not going to get into detail here right now, but I would want to point out the BD professional metric. There were about 70% of the 157 firms that qualified for inclusion in this year's analysis had a dedicated BD person or team, which we think is a reflection of the market today. Committed GPs in North America, about 70% have a dedicated BD person or team, and that's a percentage and trend we expect to continue to grow. I will comment that each of the best-in-class performers in the 8 respective peer groups we've tracked, meaning the firms that had the highest market coverage in that peer group, had a dedicated BD person or team. So it definitely makes a difference to have that capability in-house. Moving on to the next slide, we give perspective to our clients on how their overall market deal volume is trending. So a chart like this breaks down the number of closed deals by month in their target market. So it's a really good visual to see what overall volume levels are looking like. And then their color coding tells them their interaction. Did they see it, saw it in pass, or bid on it? And then that LTM coverage, which says of the last 12 month deals in our market, what share did we see? And our objective, our goals working with our clients is to always make sure that blue line is moving up over time. Moving on to the next slide, we for those of our clients that have multiple verticals or are generalists, we break down their target market by vertical so they can see what overall deal volume looks like in those verticals. And if they're underpenetrated or have less share of mind with their intermediary community, in certain sectors and make those adjustments moving forward. And then finally, we also offer perspective based on where the professionals that are bringing deals to market are located. So are there certain geographies where deals are coming to market that you just don't have a presence or a share of mind as high as you'd like it to be? And this could be a roadmap to help prioritize where to hire deal sourcing professionals, build out the team as travel becomes more of a thing, how to plan and prioritize your trips, etc. And so these are some of the key takeaways and metrics that come out of this Dober analysis on how to better direct resources for their target market and their objectives. Each PE firm has different takeaways. This came out last month, so we're in the middle of kind of working with all our clients to make sure they understand the key takeaways and working together to avail themselves of any opportunities that have presented themselves through the analysis. And of course, all our clients have the granular detail on all the deals, the contact data, what was seen, what was missed by intermediary professional, what private equity assets may be coming to market prior to them coming to market. And so they can clearly see which existing relationships they may want to strengthen and which new ones they may want to form. So with that, I'll turn it back to our moderator, David.
Thank you, Nadim. Nadim, quick follow-up question. I'm wondering, obviously investment banks that are running processes do not like it when they don't lead to a transaction. And yet your statistics show that, a very high percentage of these deals simply do not reach the finish line. Are you seeing any change in that percentage over time? I know investment banks are taking some steps to raise their batting average.
I think two answers to that question, David. In 2020, which was a very unique market, which had because of COVID, a lot of stalled processes, a lot of delayed processes, a lot of things didn't ever kind of come back to market. So when you look at what showed up in a private equity firm's deal log prior to COVID, those percentages actually dropped in 2020 in terms of closing rate. But you have to understand the nuances behind this. People think of the more established players like Chris and Lincoln and some of the other firms out there. Their closing rates of deals they bring to market are very much higher than the averages that you're seeing there. But when you look at across the spectrum, think of all the firms, kind of the boutique shops, the small folks that have an idea, a deal opportunity, it gets logged in a private equity firm, it really doesn't end up trading. So, on the one hand, maybe on the upper limit, certain investment banks and intermediaries could have an 80-90% closing rate. And on the other hand, there's hundreds that have a 0% closing rate. So when you look at it from that perspective, that's what's behind, those lower percentages.
Got it. All right, let's move into the discussion portion of the program, and I'd like to kick things off with a couple of polling questions to take advantage of our large audience and the collective intelligence that we have online. So I'm going to launch the first poll here. How do you expect your firm's total number of platform deals next year, so in 2022, to compare with this year? So make your selections. All right, I'm going to close the poll and share the results. Okay, so a lot of optimism going into 2022. Most popular response, over a third of you selected, is up to 10% higher than this year. So as crazy as this year has been, 2022 is expected to be even crazier. One more polling question, and this time we'll ask about add-on acquisitions. So a very similar question: how do you expect your firm's total number of add-on deals in 2022 to compare with this year? So again, go ahead and make your selection. All right, can I hear the results? So it's a little interesting that up to 10% higher than this year is again the most popular response, but it looks like the second most popular answer is even with this year. So so very interesting. So a lot of optimism for deal making in 2022, and let's turn to our expert speakers to get their read. And that really is the first question I have for my panelists, and I would like to hear from each panelist in turn on this first question, and that is, what is the outlook for deal flow for 2022? And in particular, which industries do you expect to be particularly hot next year? And Chris, why don't we start with you?
Sure. I agree with Nadim. I mean, this is a record year, and you saw Q1 to Q3 data. I think Q4 is going to be even more impressive. I think a lot of deals were pulled forward from 2022 to 2021 because of tax reasons and other reasons, valuation and liquidity in the market. So I do think 2022 will be down over 2021, but I think it still remain strong through the first, call it, 9 months of the year. I think with an election coming at the back half of this year, I think we might see a little slowdown as people wait and see what happens with the House and the Senate. Also, the Fed has talked about raising rates. That could all make an impact on this. And if there's any other regulatory changes, could have an impact. But if everything remains status quo, I expect it to be strong. And the reason is, if we think about it, the economy still isn't fully open. California, the 5th largest economy in the world, didn't open up until June, and even now it's partially open. So we're hoping that in 2022, a lot of these states open up. And then second, we think about the supply chain. A lot of product hasn't made it from China to here. We're hoping that this pipeline clears out, and that with the new supplies coming in 2022, that should give us a little more economic boost.
Thanks, Chris. Jeremy, what's your view?
Agree 100%. So I don't want to duplicate all of Chris's comments, but we're seeing exactly the same thing. And a lot of the activity this year, to Nadim's point, will spur add-on activity next year. So as we close these platforms and we get well into our strategic planning and launching into those systems improvements and implementations, we'll be ready to do add-on acquisitions to those platform companies added. So it will remain strong.
And Jeremy, any particular industries that you're looking for especially big things from next year?
Yeah, in the last 18 months through this chaos, what we've seen is a huge flight to essential services, electrical, plumbing, HVAC, all of those kinds of businesses that are absolutely necessary will continue to be very active. Consumables, ingredients, flavors, food businesses, things like that will continue to be very strong. B2B mission critical software will remain red hot. Everyone saw the resiliency of all of these industries through the last 18 months, and so everyone's gotten up to speed and focused on the same areas, and those will remain red hot.
Thanks, Jeremy. Anything to add to the list of hot industries, Chris?
Sorry, I was on mute. I think, we saw companies impacted by COVID, and we hear about a COVID bump. So people that were selling, let's say, patio furniture got a bump in 2020, 2021, and is that sustainable or not? So I do think some of the companies that were negatively impacted by COVID, we'll start seeing them coming back this year. And some of them that were positively impacted, that investors said, to Nadim's point, some deals didn't get done. I don't believe it's sustainable. and then how they performed in 2021, 2022, they may come back also.
Thanks, Chris. And just a friendly reminder to my fellow speakers to stay on mute. I am getting a little background static coming through. Scott, what's your outlook for 22 on the co-investment front?
I think it'll be busy. I mean, notwithstanding, to Chris's point, the fact that a lot of deals have been pulled forward from 2022 into 2021, I also believe that a lot of those deals are just not going to have enough time to get closed by the end of the year, and we're going to see a number of those roll into Q1, even if the transaction participants were hoping to get it done in Q4. So I think the momentum will continue through Q1. Then we'll see a little bit of a lull, and then who knows, right? Then inflation, interest rates, economic growth, geopolitical events, right? That any of those things could start to influence the trajectory second half of next year. I think Jeremy hit it on the head in terms of sectors that feel kind of hot right now. I was going to say essential business services is sort of the number one category. HVAC, anything maintenance or repair related, durable businesses that have stood up well in the post-COVID environment are in high demand. The one category I didn't hear from him that seems to be in awfully high demand right now and seems no signs of letting up is veterinary services. Seeing lots of consolidation in that part of the ecosystem, and don't think that's going to stop anytime soon. I think the one sector that's in our opinion just facing a lot more uncertainty, right, is the manufacturing and industrial category. There's just so many factors that seem to fall outside of one's control. Makes it hard to underwrite go forward projections, whether it's energy prices or tariffs or supply chain disruptions, labor shortages, wage inflation, and whatnot. I know we're deliberately leaning out of that category right now and favoring higher recurring revenue business services or other categories where there's just a lot more visibility and things within your control.
Thanks, Scott. I can definitely speak from personal experience on the pet explosion in pets. Everyone in my apartment complex here in South Carolina seems to have a dog, and they're going to. It's I think partly due to the pandemic, and it's a trend that has a lot of life ahead of it. All right, let's turn to another big question, and that's how all of this deal activity has impacted pricing and the leverage levels that lenders are willing to provide. Chris, you probably have the best view of the market on that, so let's turn to you.
Sure. As we discussed, valuations are consistently at double-digit multiples. The pet space we were discussing is at high teens multiples. And lenders are looking for equity behind their debt. And as long as you have this kind of 50% debt to cap in deals, we think 2022 leverage levels will stay where they're at. There's a chance that leverage levels may tick up. However, on pricing, I don't think pricing is going to get better. For the last 6 months, it's already dropped 100 basis points. It's at a record low. Would have to be a new record low for pricing. Bigger risk is if inflation starts coming and the Fed starts raising rates, will pricing go the opposite direction? But in general, we think leverage levels will hold as long as valuations hold and high equity checks, and pricing should be at current levels.
And Chris, what are you seeing right now in terms of leverage levels, pricing levels on a mid-market down the fairway type of transaction?
So in Q2 of 2020, leverage levels fell to 4 times EBITDA, and now it's back up to 5 times plus EBITDA. Obviously, in some good recurring revenue model deals, high equity check deals, they're seeing 6 times EBITDA, but 5 is the median of what we're seeing in the last quarter. And in terms of pricing, Jeremy could correct me if I'm wrong, but I think LIBOR plus 650 plus or minus is a very attractive pricing these days.
Okay, let's turn to a topic that we did touch on a little bit earlier, and that's the prospect for higher interest rates. It always seems to be with us, but interest rates have moved higher this year, so there's that. What impact would rising interest rates have on deal flow? Jeremy, give us your take on that.
I don't know that interest rates directly impact deal flow as much as deal pricing, as it impacts the model as you project your returns. Hopefully, the rates won't increase too quickly, and so it won't have a dramatic impact. I think at the end of the day, we're still having overwhelming competition on most opportunities, and that still keeps will keep multiples quite strong, and the trend should continue indefinitely as we look at the large generational transfer that needs to occur. The size of the baby boomer generation is just so large. All those companies will need to be transacted in some form over the next decade, and that will outweigh interest rate changes and whatnot to keep deal flow strong, even if there's some ups and downs quarter to quarter or through the political cycle. You'll still see overall deal flow.
Thanks, Jeremy. And Chris, I wonder if you would give us the details on the prospects for tax changes in the months ahead from Congress and what impact that would have on the deal environment.
Sure. So, the president has requested to move the capital gains tax rate from 20% to ordinary income rates of 39.6. The current Democrat plan coming out of Congress has capital gains going from 20 to 25%, with a 3% tax on everyone above 5 million, which, as you know, all the deals that people on this webinar do are above 5 million. So let's call that 8%. So somewhere between 8 and 20% is a current Democrat ask. If you have a company that's worth $250 million, that's going to be anywhere from $20 to $50 million more in incremental taxes. And let me put in perspective for Jeremy and I and everyone else that lives in the high tax state of California. If you're at a 40% tax rate in federal, you have your 3.8% Obamacare tax rate, and then you have 13.3% state California tax rate. That would be a 57% tax rate on capital gains, and that would have a negative impact on M&A deal flow. At a certain point, owner entrepreneurs will just sit there and say, I'll keep the company, run it for cash flows, give to the next generation. But when you build a company from scratch and you're selling it you pay taxes throughout your career, and now it's at 57%. My hope is that we don't get to this level, not to get political, but there are a lot of other things to worry about in terms of infrastructure and other geopolitical issues. And I'm hoping the Democrats will focus on the infrastructure bill and other needs versus taxes this year.
Thanks, Chris. I want to turn to Scott. And Scott, you see the sourcing operations across a vast array of general partners as well as independent sponsors. And I wonder if you would speak to just how tech savvy and how tech advanced general partners and independent sponsors are these days.
Well, as you'd imagine, there's a spectrum, right? There's still the old school folks that rely on their Rolodexes and portfolios of business cards, and they're just out there pressing the flesh trying to find deal flow. But at the other end of the spectrum, the past 3 years in particular, we've seen a number of GPs developing their own proprietary systems, and they're pretty advanced in some cases, to help them identify companies well before an intermediary brings them to market in some sort of formalized process. And you'll hear all the buzzwords, right? AI and natural language processing and predictive analytics and whatnot. But the concept is to try and reach out to the internet and scrape a bunch of information sources and populate a proprietary database of metrics and information on a number of companies, and try and then apply some rules-based algorithms to stack and prioritize those companies into ones that sound the most interesting. And then you just marry that with good old-fashioned sourcing hustle and go out and do some cold calling and try and get in touch with these businesses. But they're doing everything from scraping websites and LinkedIn profiles to looking at job postings and hiring trends, conference attendance, IP filings, financing rounds. Some of the GPs are claimed to be pulling sources data from up to 1,000 sources to build these proprietary databases. And at the end of the day, they're just trying to find companies before others do. And I think the most interesting one I saw was an app that was built on top of one of these databases that has like a Tinder-like swipe left, swipe right feature to it, so that when the GPs are commuting, to and from work, they can see what their system is spitting out in terms of potential leads, and then they can prioritize those into buckets to do some further research or to just put them in the discard pile. But as you might expect, the groups that are more tech savvy on this front are some of the IT focused firms that sort of understand how to play that game. I think the industrial manufacturing oriented GPs are still doing the same old thing, calling a bunch of bankers, as many bankers as they can, to try and find interesting companies. But you're definitely seeing a sea change in how sourcing is executed amongst GPs.
Thanks, Scott. Nadim, I wanted to ask you a follow-up to that question, and whether you're seeing clients of yours or other private equity firms do anything particularly innovative with social media or AI or some more advanced technologies.
Yeah, let's start with AI. The high-level answer, David, is that firms are trying. They're very much hiring data scientists, hiring consultants, and this is a movement, a trend that's going to have tons of impact in various industries and sectors over the years and decades ahead. Now, private equity is going to be a little bit slower than some of the other industries in adopting technology in general. And without getting into the semantics of AI, in my view, what is truly AI, the bar is pretty high. It's not just coding or a set of rules or automation. It's for lack of a better term, it's thinking and intelligence evolving on its own in helping. And I'm not aware of a tool or a firm that's been able to do that successfully in private equity. But I will end that sentence with yet, because I think people are investing in this. We see a lot of firms building in-house data science teams. They're trying to answer this question, but we're very much in the early phases of trying to figure this out. And I'm excited to see where it goes. On the LinkedIn side, we do see firms getting more innovative, creative. Now, that's a whole kind of a different topic. LinkedIn has proven to be a great medium to expand your reach, establish your brand, get awareness in your market. And when you look at private equity firms, they have like 3 constituents that, in general, that they can market to. It's the LPs and their investors, who are their customers. It's intermediaries and other sources of deal flow. And it's the companies and CEOs and families themselves. And I think the most effective thing I've seen some GPs start to do is using it as a medium to establish their brand among their sellers, among sellers and CEOs. I think at this point, if you have a few different buyers that you might be in talks with, as an owner, it's very easy, or you can think of a scenario where they're going to go into LinkedIn, check out the company's page, what are their profiles, what are their feeds, and maybe if the owners aren't doing it themselves, their kids are definitely urging them to do that. So it can be a great medium to connect with your audience at a personal as well as a professional level, to show, what is brand at the end of the day? It's like what you stand for, what your values are. And LinkedIn can be a powerful medium, still very much a greenfield operation. As a service provider, we're trying to figure it out. And I do see some GPs starting to do a really good job of using it in that way to establish their brand and identity. And I think it's going to pay dividends in the years ahead.
Thanks, Nadim. Yeah, I have a little bit of breaking news related to on the data science front. Ross Koenig, longtime data guru for RCP Advisors, Chicago Funds of Funds, he's moved to Shore Capital to be their data scientist. And I'm curious what they do. Jeremy, can you shed light on that? Do you have data analytics people there at Riverside? Or
We are blessed to have an unusual scale for the lower middle market. There's more than 300 Riversiders around the world, and we have an internal IT team that controls and drives all sorts of projects. But I think the industry is really just scratching the surface overall, and there's a lot of room for improvement. At the end of the day, the marriage of relationships and the data guiding how to spend your time more efficiently and effectively is going to be absolutely critical for everyone, not just the more sophisticated, larger firms. But I expect that the small firms will radically adopt these practices as well.
okay, let's turn to this a trend in the market where we're seeing a lot more private equity firms teaming up on transactions. Of course, we used to see the biggest buyout shops team up on some of the take privates and very large transactions, but now we're seeing that in the upper middle market, even the lower middle market. And of course, we continue to see private equity firms sell companies to one another, and in some cases stay as minority investors in those same companies after they sold. Jeremy, I know you've given this some thought, so I'd love to hear your view on where the trend is heading, and then we'll turn to Scott to get his perspective as an LP.
Yeah, absolutely. It's been great to see the industry mature in this way. Years ago, firms were fighting for attribution, and they wanted to prove to their limited partners that they were the ones creating these outcomes, and they really wouldn't want to necessarily bring in another group. And the much more well-established groups now view it quite the opposite. It's whatever creates the best outcome. And so we've been very flattered to have been invited in. We have a non-control only structured equity team that has been invited to participate in investments with Vista Equity, Harvest Partners, Abry, the Jordan Company, Kohlberg, HKW. The list goes on and on, I guess, but it's very flattering because they don't need our capital, but it's something else that we can bring to the table and help them. And we expect that trend to continue to accelerate as firms are less interested in attribution and more focused on providing premium returns.
And Jeremy, what about the phenomenon of private equity firms selling companies one to another? LPs in the past have complained that if they're in both of those funds, they really don't ever get to exit. What's happening there?
I understand the point. It's difficult for us. We don't have visibility into who the buyers LPs are. Each board of each portfolio company is making their independent decision on their exit timing. We're hiring somebody like Chris to run a process, and ultimately a buyer is selected. And it's more about providing great returns to our LPs. It would be very difficult, if not impossible, for us to know which LPs are in those buckets, and we wouldn't want to but we are seeing a lot of creativity as you start to see these continuation vehicles, and there's more optionality where some LPs are happy to sell and take their return, and others want to stay in an investment for a longer period of time. We're hearing a lot of positive feedback from LPs on being given that choice, and so there's a lot more flexibility, and I think we're going to see a huge surge in that kind of continuation vehicle behavior in 2022.
Okay, and just a friendly reminder to speakers to remain on mute when you aren't speaking. And Scott, we want to get your take on that trend as an LP. This growing collaboration among private equity firms on deals and on selling.
Well, there's certainly collaboration, as Jeremy points out, but I don't think we're seeing like a groundswell of club deals, certainly not in the lower middle market or middle market, not like the way we saw it back in 05, 06, 07, 08, right? When the SunGuards and NXPs were all getting done with these big syndicates of large private equity firms. But we are seeing a lot more creativity. And look, I mean, to the point you made, David, sometimes LPs get frustrated. Well, gee, I own a company here and it's just selling to a fund over in this pocket, and all I'm doing is losing 20% of the profits along the way. It all depends on how your program is positioned. We try and deliberately position our entire program at the smaller end of the market with the explicit awareness that we're likely to sell up the food chain to either strategics, but in many cases to larger private equity firms, and that's fine. It's part of the natural evolution. You take a company that's got $5 million of cash flow that a small sponsor finds, and they grow it up to 10 or 15, sell it to the next middle market guy, and so forth. And it's not uncommon to see some deals that have been passed along 2 or 3 or more times with continuing success. What we are seeing is, though, some of those smaller GPs getting frustrated that, you know, they may print a good outcome and sell it to another private equity firm who then makes a similarly good outcome, and they feel like they've left a lot of profit opportunity on the table. And so that's where the creativity comes into play with these continuation vehicles or top up annex funds, or, you know, any number of different flavors that allow GPs to retain essentially control of their best assets for a longer period of time. And that works fine for most LPs, right? You have the option in most instances to either cash out or roll or participate in some of these continuation vehicles. I agree with Jeremy. We're going to see, we're already seeing it, but we're going to see a continued explosion of continuation vehicle type situations going forward. And it's actually not bad for LPs, because they will have more optionality in their ability to lean in and out with their private equity allocations when they need to, based on how their overall program is developing.
Thank you, Scott. And Scott, I want to stick with you because I've been reading about auction processes where due diligence periods are really getting compressed, and periods of exclusivity may not even be offered in some hot auctions. What can you tell us about what's going on in the trenches, Scott?
Well, no doubt for the best companies, the best assets, those that have proven their resilience and durability over the past couple of years post-COVID, those are the ones that are in the highest demand. And, you know, Chris will be able to speak to this as an intermediary, but they're going to drive processes that are as efficient as possible. And if that means compressing diligence time frames, or running multiple parties through full diligence all the way up to fully financed, fully diligenced bids, then they're going to do that because they want highest certainty of close. And, you know, as a PE firm, that can be frustrating. You might end up spending hundreds of thousands or more on diligencing a particular business, only to lose at the end of the day. But it's your choice whether you want to participate in that auction and chase that asset. But we're definitely seeing for the most high quality companies intensely competitive intermediated processes that are designed and frankly are being successful in capturing the highest prices for the sellers.
Hi, how are you?
Chris, what are you seeing on that front?
Scott said the key word, certainty of close. I always tell my clients where to focus, right? It used to be just value. Now we've moved from value to certainty of close and timing. And for our own entrepreneur clients, we add fit. And that would probably be higher when you're rolling over equity and staying on. When you're looking at this year and this rush to close before year end, certainty of close and timing is truly a differentiator. Scott's right. People are spending 6 figures, sometimes up to 7 figures. But those that are winning are saving on not paying $10 million higher on purchase price. So I can tell you the last 10 deals I've done, my clients did not choose the highest purchase price. They chose fit, certainty of close, and timing. What certainty of close? You know, we put a stock purchase agreement in the data room. Most people mark it up. The smart guys are right now doing 1 or 2 turns before the LOI. So my last 2 deals, the buyers, the winners, had done a multiple turns. The first one said exclusivity only 3 days. The second deal, the guy said exclusivity only 10 days. Guess who won? The 2 that were not asking for 60 days exclusivity, because that showed us certainty of close. The longer your request for exclusivity, the less confidence we as sell-side bankers have on your ability to close. And then, QV, spend the extra $50,000, $100,000, get the QV done. And there's just one less thing to worry about, because when we talk about it, it's purchase agreement, it's QV, it's financing, and it's your confirmatory due diligence. The first three could get out of the way very quickly. Talk to some lenders and provide a highly confident letter. We're not looking for committed financing, but something that can be done in the middle market. And the ones who are doing the early work, I think, are getting a great return on investment, because, like I said, they're spending $500,000 to $1 million, but they're winning at $10, $15, $20 million less on deals.
Very interesting. All right, we lost about 10 minutes to the technical breakdown, so we're going to go to approximately 12:25 with this program. I really appreciate everyone that stuck with it, especially the speakers. And I want to encourage everyone now, with about 15 minutes left, to ask any questions they have of the panelists. You can do that through the GoToWebinar control panel, and we'll address any questions that come in. For the moment, until that happens, I want to turn to the topic of proprietary deals versus limited auctions versus broad auctions. Nadim, you mentioned during your presentation you've developed an algorithm that helps you sort of track those. Can you give us a feel for, just across the market today, what percentage of deals fit into those different categories, very roughly?
Yeah, David, I think from a number of deals standpoint, we're still seeing a healthy proportion being either moderate or broad processes, definitely a majority between the two when you look at deal counts. But when you look at the number of intermediaries, especially the ones doing maybe 1 or 2 deals a year, there's hundreds of intermediaries that typically run more limited processes. I will comment, we were just discussing this internally, and we want to write some thought pieces and put some charts and stats behind this. Traditionally the perception has been, and the data has supported, that if you are a boutique, if you're a smaller company, in general, you're going to be running more limited processes. And if you're more of an established player like Lincoln, you're going to be running more broad processes. Certainly that's the perception, and to a certain degree it plays out in the stats. Lately we're seeing more and more using this index and the hard data, not just from people's subjective kind of input, but from the algorithms that we've built. I'm often surprised, and so are our clients, by these boutique firms that are on the broad end of our sell-side index spectrum, meaning relative to their peers, they're running pretty broad processes. And when we generate league tables and say, show me all the deals that got done last year that were limited processes, I am also surprised to see some of the more established names on that list. Yeah, maybe they did 100 deals last year, but 15, 20 were actually pretty limited processes. So this is an important area to track, and we're watching it closely. We're working with our clients on it, and so that's the data. It'd be great to get perspective from the people that are actually in the weeds running these processes. Chris, are you seeing a trend from sellers to run smaller processes, or not really?
Absolutely. I mean, Jeremy and I did a deal together this summer where we only went to 10 buyers. And I know some people say only is not proprietary, but in this market, 10 is proprietary. We have 2 other deals right now that are under LOI, and those only went to 10 buyers. It depends on the client. If the client wants a broad process tested, we do it. If the client sits there and says, I want to go narrow, I'm okay not testing the market, we follow the client. The other thing that's the impact is there a clear buyer of this company? And when there is a clear buyer of a company, then we know these are the 5 or 10 best, and that's who we go to. If there's not a clear buyer, it's adjacent markets, we want to try something different, that's another reason why we will go broader. But for sure, we are going more narrow today than we were in the past. And sometimes it's only 1 or 2 where we'll go to a strategic and say, here's the opportunity, the book is written, the data room is done, The model's done, the QV's done. Give me a price. If we like it, we'll work with you. If not, then we'll take it broad. So we're trying a lot of different things here.
Yeah,
Jeremy?
and that pending tax change is a key driver of that. When the entrepreneur says, I got to get this done, there isn't time to deal with herding cats that may or may not be there. We've been the beneficiary, and many times, especially with add-on acquisitions, where we've had one-off discussions and the banker says, look, we've got all the materials, the data room's ready, we can launch a broad process, but our client knows your portfolio company management team, loves the corporate culture, respects them, thinks it's a great home. Here's a take it or leave it price. Completely one-off proprietary dialogue, and that he said, look, if you can hit this premium number, you can have it, or we'll run a process. And pretty frequently those deals are getting done.
Jeremy brings up a good point. Given where we are in the year, when I'm saying we went to 10 buyers, it wasn't 10 strategics. It was 10 private equity firms that we knew could get the deal done. They knew the industry, they have a track record of moving quickly, and that was different. I mean, sometimes we want to bring those European and Asian strategics. They're not built for Western M&A processes. They take too long. Even US strategics, we sent one NDA out, and the guy said he wanted another month after IOI date to submit his IOI. I wrote back to him saying, we'll have our LOIs by that time. And so the strategics can't keep up with the private equity firms. So which is nice for me is I can bring my client multiple options. Private equity, move quickly, get it done, or strategic might be able to pay a higher value with synergies. Which route do you want to go?
Okay, we have a question from a registrant, a participant. Can you discuss competition among non-sponsored players, both structured equity and private credit, and whether you view them as precursors to a traditional private equity LBO? And Jeremy, I know you cover all of those areas, so why don't we ask you that?
Yeah, I'm not sure if I followed the question completely, but what we are seeing are a lot of partial liquidity events, a lot of non-control reshuffling of the shareholder base. So example would be a second, third generation business. You've got Cousin Eddie who inherited 20%, but doesn't work there. And the people, the family members that are there every day, charging forward and driving the business, there becomes friction with those receiving dividends that don't work there. And it makes Thanksgiving a lot friendlier if they can buy Cousin Eddie out and accrete ownership to those who stay on. And then often there is a full transaction, a full sale, 5, 7, 10 years down the line after they've driven it to the next level. But we are seeing a lot of creative flexibility and distributions and recapitalizations.
Okay, with the final few minutes, we're going to turn to best practices in deal origination, and this is a chance for the speakers to provide some practical advice to young originators on the call or folks that want to get into private equity origination. And first question for Jeremy is, what makes a junior originator exceptional, and how can they develop into an outstanding senior originator?
First and foremost is being proactive. There's so much going on that they need to get into the rhythm and the cadence of a process and how we're moving things through the system, and not wait for the senior originator to repeatedly ask them to do things. They know what the next steps are. They're anticipating it. They're being proactive. They've heard the comments at investment committee, and maybe they take a first cut at an IOI template so that they filled in the banker's information, all that kind of stuff, and then we can go in and polish it and review it without even having to ask them to do so, because they realize that it's going to the bid will be going out, those kinds of things. They need to be proactive in building their own network. They can start to build relationships with their peers and their own kind of age bracket very easily, and not wait for us to be the sole source of relationships in the firm. And the reality is, often lists are created by junior to mid-level folks at the intermediaries. So it's a clear value add for them to be maintaining mind share with people in their same age bracket. For their own development, they need to think like an investor, not like a deal finder. So it's not just about finding a deal or bringing in SIMs, but it's that triage of we should take this to committee or we shouldn't, and here's why. And proactively jumping into that, reading the SIMs, sending the senior originator pros and cons and a recommendation of whether or not it should go. And sometimes we overrule their thoughts because they didn't realize that the firm had experience in that niche prior to them joining and whatnot, but it helps them refine their lens of looking at deals by getting out there and making that call. And I'd say probably finally is leveraging the senior originator's time. If you know that they're going to a conference and they've got 12 meetings lined up, there's some pretty logical things that you could do. You can pull data from, create a little dossier, for lack of a better term. You can pull the data from the CRM on the recent deal seen, whether we bid or not, the outcomes, how long it's been since you last saw that person. They could create profiles that would speed the senior originator's prep time for those meetings. And the more you leverage somebody else's time, the more invaluable you are to them. And ultimately, they're going to invest more time in you because they're going to start to view you as a critical colleague or counterpart and less of a senior junior relationship.
Right. Chris, I imagine there are some BD professionals that you look forward to getting on the phone with and can't wait to talk to, and others that you'd rather not deal with. What makes that first BD professional?
So I'll answer this first one in the sense of I like peer-to-peer calls. I'm a partner level, I'm a managing director level. I like calls from people who are at my level. That shows me that you're committed to the relationship. I also like calls from decision makers. There are some BD professionals who are not on the investment committee. And when we get to a pitch and I call the person back saying, hey, can you help me on this deal? We're pitching, they're like, well, I don't have a say. So at my level, I like the peer-to-peer. My advice to people who are not, let's say at Jeremy's level, is to make relationships with people at your level. You look at Jeremy and I, we've known each other for over a decade. We were both not partners when we met each other. We were mid-level bankers and we grew up together, and that relationships fostered over time. This desire for a VP or associate to call the managing director, he already has a relationship if he's been doing this for 20 years, or she has. So I would encourage them to make, one, relationships with their peers. Second, calling bankers, we run our processes. It's really hard for me to give someone something proprietary unless there is something in return. So when a sponsor calls me and says, hey, Chris, can you give me a proprietary deal? I need one. I'm like, well, there's 1,500 sponsors out there. Everyone needs one. What is the differentiator? Well, do we have a track record of you performing well in our processes, right? What is our history with you? And so what I would encourage young BD professionals to do is develop relationships with non-investment bankers. What I do, lawyers, accountants, wealth advisor. All of my deal flow comes from them because I don't have to cold call a company. The lawyer is a trusted advisor. The accountant is a trusted advisor. The wealth advisor, trusted advisor. So they're already in, and I get that warm intro from the intermediary into the owner entrepreneur versus me cold calling, because I do the same thing. I mean, BD at private equity is no different than BD at investment banks. I have to go win deals, and owner entrepreneurs are just as difficult with me as they would be with a BD professional. They don't return calls. They don't want to share their financials. All the concerns that they have is there. So I've changed my business model to try to get in through the intermediaries instead of directly.
Thank you, Chris. Scott, any advice for the aspiring sourcer of co-investing deals?
Yeah, we're in a slightly different part of the ecosystem, right? And for us, we're reaching out to GPs on a daily basis or independent sponsors, right? And we're letting them know that A, we have capital to invest in co-investing. We can move quickly. We can get, it's just as important to get to a quick no as it is to a quick yes. They want to work with people that they like, that they can resonate with. The worst thing that we can do, if Jeremy calls me and says, hey, I got to co-invest, and then I burned 5 calls with a bunch of his team members asking a whole bunch of rudimentary diligence questions, and then I wait on it a week, and then I say, it's probably not for us, or we don't have any money, or something like that. I'm never going to get the call for a co-investment from Jeremy again. So we're doing the same thing that Chris recommended. We're encouraging all of our team members to start to build relationships with their counterparts at the GPs, building that good guy factor and letting them know that we're not only good for the money and we can make quick decisions, but that we actually can add value after the fact. And that might be making introductions. I can't count the number of times in the last 12 months where we've co-invested in a company and then gone ahead and introduced the GP to another GP who's invested in that same type of business in a different geography to explore some key learnings, or we've gathered data on operating metrics and best practices and things like that. So adding value after the fact is also important for LPs in sort of establishing a meaningful co-invest program.
Thank you, guys. And Jeremy, we'll let you have the last word on the program, because we have a very specific question from someone who evidently works at a large firm. How do I navigate a firm internally that has many siloed deal teams, and how do I keep a communications cadence as a BD professional?
Yeah, it's actually typically pretty simple. Asking each firm how they want to interact with you. Going back to Chris's point early on, he made it clear to me. I made that mistake that he's referencing. One of my junior people called Chris, and he reminded me that that was not his preferred mechanism for interaction. Increasingly, there's folks like us who are the jungle guide for someone. You've got a designated point of contact to help you guide through that organization, whether it's a sponsor coverage person at an investment bank or it's somebody like myself at a private equity firm. You need to know who your go-to person is that can quickly get you to the right team, the right decision maker, pull together resources and get you an answer. But that's increasingly formalized. And so that's become easier. In the few firms that don't approach it that way, you just have to put the frustration aside and view it as each silo is a separate firm and have a point of contact with each team. And depends on how your brain works, if you want to create separate CRM profiles and treat each fund or each silo as a separate group, it's often more effective. We see that in some of the large investment banks that have grown through acquisition quickly, is you have to maintain different dialogue with each team because they have different P&Ls and they're so busy working on their own deals, they're not aware at all of what their counterparts in Europe are working on. So you can't assume that your friend in LA is cluing you into an opportunity in London.
Okay, thank you very much, Jeremy. I'm afraid we are out of time. I'd like to thank everyone for coming, and especially those who stuck with us through the 10-minute technical gap. I'd like to thank our sponsor, SPS by Bain & Company, for making the webinar possible, and really would like to thank our speakers for doing a fantastic job of preparation for the program. Nadim Malik of SPS, Jeremy Holland of the Riverside Company, Chris Petrossian of Lincoln International, and Scott Reed of Aberdeen Standard Investments. Enjoy the rest of your day, everyone.
Thank you.
Bye-bye.